The next important date, I think, in my little story for you is 1990. In 1990, there's an article that's published, an article entitled Core Competence of the Corporation. And with that article's publication in 1990, we see the introduction of a management idea, which I dare say today, 20 years later, has become a prevailing orthodoxy about how we think of management. That is to say that the job of companies is to focus on their core competencies. It's curious, if you go look in the literature before 1990, before the publication of this article, and you go to Google Scholar and you type in core competence or core competency, you get about 120 results. If you set the time, I did it setting the time between 1970 and 1990, you get about 120 results, and they're all from nursing. I don't know why, they're all nursing articles. And then in 1990 to 2000, with the publication of this article, you get 5,000 results, all of which are about management. And by 2000 to 2010, that number has ballooned to tens of thousands of articles. So you can actually see through Google the emergence of this idea as a form of management orthodoxy. Why does core competence catch on with such enthusiasm at the heart of so many firms? Well, let's examine what core competency preaches. Core competency says firms should not think about themselves as vertically integrated operations. Firms instead should think of themselves as a series of, as a core competence. And it's that core competence that actually drives firm value. In other words, firms have been looking in the wrong place to answer the question, what drives the value of the firm? They've been looking at the sort of transactional ideas that we saw earlier about domesticating transactions, creating transactional efficiencies, and using those to drive productivity and competitivity. But with the core competence idea, that idea of vertical integration can be discarded. Instead, what you do is you focus on what you do best, and you do that, and you use that then, you use a relentless focus on that to drive value. That principle is still with us today. Many of you will be familiar with the concept of core competence because it has become, I think it's fair to say, a kind of management orthodoxy in terms of how to drive value. Well, what this meant for firms in the 1990s was, here was a way of thinking, if you will, a way of thinking about the firm that seemed to provide a great deal of potential for unlocking hidden values in the firm and thereby helping to drive value, enterprise value. The nice advantage of driving enterprise value is it tends to show up in your share price. So if you can unlock that value that's implicit in your firm, guess what? The markets will reward you with a nice expanding share price. So it's very consistent with the idea of using the share or using your share price as a kind of oversight for how you're doing. A very, very famous example of a firm that embraced the core competency idea in the 1990s comes to us from Sara Lee. Americans in the room, you will know Sara Lee perhaps as a brand, actually a number of brands under the Sara Lee basket. What does Sara Lee do today?
Make desserts.
Yeah, it makes cakes. Is that what you're saying? It makes cakes. Is that actually true? Does Sara Lee make cakes? They sell under their name cakes that other people make. They used to make cakes prior to the mid-1990s. They used to have a series of bakery operations, and people would show up every day and make nice cakes for Sara Lee, and then they would put them into their distribution chain and sell them on. But in the 1990s, Sara Lee undertook a very famous strategy, de-verticalization, they called it. De-verticalization. That is to say, the vertical integration of the firm was chopped up because they focused on their core competence. What was Sara Lee's core competence? It was, in fact, a brand. It doesn't matter who makes the cake. As long as it has the Sara Lee name on it, as long as it has that kind of signal for quality, it's a Sara Lee cake. And so the CEO in the 1990s, recognizing that the value of Sara Lee was not in its baking specialization, but in fact in its brand value, sold off all of the baking operations and simply became a brand management company. And that was, I should note, warmly rewarded by the market. Indeed, one of the suggestions was that the reason for Sara Lee's deverticalization was to unlock shareholder value, help drive value into its share price during this period. And it was certainly successful at that during the 1990s. If you'd like to find out what happened to Sara Lee, it's been in the news recently. You can go and Google Sara Lee. You can find out where it is today. If we have time, maybe we can talk a little bit about that. There are long-term consequences to this kind of radical deverticalization, but in the short term, in the 1990s, it certainly helped boost Sara Lee's value because it allowed them to get rid of a lot of costs and move them outside of the firm. So this idea of core competence, I use Sara Lee as perhaps a somewhat exaggerated, but nonetheless I think fairly representative example, allowed firms to understand where their value was derived, and such that we find many firms moving towards a core competence model, and the value of that core competence model could be found in higher share prices. And indeed, what do we find in the 1990s? We find a rapidly increasing stock market, so that as firms embrace these strategies to unlock firm value, it shows up in share prices as investors become enthused about the potential for firms to unlock value in the future, and share prices rise up and up and up, as we now know, in a bubble. Well, that idea of core competence in the 1990s helps us to raise, I think, an important question about shareholder value. It's one of the fundamental questions that lies at the very heart of this debate, this idea, which is about capital allocation, the efficient use of capital. And the basic question is, where will you expect to find the more efficient use of capital? On the side of the firm or on the side of the shareholder, the people who are giving the firm the capital? And that question in the 1950s and the 1960s was pretty clear. It was decided on the side of the firm. Firms should retain capital, make new investments, drive growth, get new customers, build new operations, and so on, diversification, and so on. But in the 1990s, under the core competence mantra, that idea comes under a challenge, that firms may not actually be very effective or efficient exploiters of their own capital, that in fact the efficient exploitation of capital is on the other side of the ledger, on the side of the ledger of the owners. And one of the reasons why you can understand that firms don't make very efficient use of their own capital is because that capital is subject to the systemic agency problems that we found in Jensen and Meckling. How do you know that if a firm generates a profit, that senior management is going to take that profit and put it to the best use of the shareholders rather than use it for some sort of personal gain, further their own career, further cement their place in the organization, and so on? That idea, then, that capital is actually put to greater macroeconomic use or efficient use on the owner side, quote-unquote owner side, as opposed to the firm side, I think is now a pretty strongly embedded idea. That's one of the sort of fundamental imperatives that underline shareholder value. Firms should not sit on a lot of capital. They don't know what to do with it. They don't make efficient use of it. If you put it back into the hands of the private citizen, what you'll find is, velocity of money being what it is, that you'll get efficiencies of that capital, and so it will create strong macroeconomic benefits for everybody as new investments are found and the like. Core competency certainly fits that idea. Under the core competency model, firms should divest themselves of less than efficient assets, strip them out, move the proceeds into the hands of their owners, the shareholders, and allow that capital to be put to efficient use by them. I would argue then that by the time we get to the late 1990s, mid-1990s, late 1990s, and certainly in the past decade, firms have undergone a very significant transition. And that transition has been from seeing themselves as essentially capital retention entities, that is to say, organizations, the purpose of which is to accumulate capital in order to fund future operations, expand operations, diversify operations, into operations that are designed to create efficiencies in terms of their operations and move the money that they generate into the hands of their owners. And that means that the relationship then, posited in the 1970s through the efficient market, capital market theory, that the share price provides the kind of oversight management needs in order to evaluate its performance, has become of a paramount importance today, to the point where many firms, whether they say it explicitly or implicitly, will articulate the idea that shareholder value, driving shareholder value, is a fundamental goal of the firm. Some are more explicit. Some simply say, our primary mission is to drive shareholder value. Some are less explicit and say, our primary mission is to focus on our customers and our employees, and incidentally from the benefits that that creates to drive shareholder value. But either way, shareholder value remains an embedded principle in terms of defining core corporate governance. It is simply the reality, whether stated outright or whether implicit, that defines the behavior of many firms. This begs the question, I think it begs two questions. The first is, what is the purpose of the firm? And the second is, who are these shareholders? And I think both deserve our attention in the context of this discussion.